Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
The smart way to reduce investment risk. One of the biggest fears of investors is a large fall in the value of their portfolio shortly after investing. The technical word for this is asymmetric risk. Asymmetrical risk reward is the essence of investing in stocks and is also essential for those who want to beat the market. An asymmetrical risk reward situation can be both positive and negative. A positive one is where you can only lose an amount that is smaller than the potential reward. A negative risk reward situation is one where you can lose more than what the potential positive reward is. A smart way to reduce the asymmetric risk is by drip feeding your investment using a technique known as pound cost averaging, rather than investing all of your money up front. So let me give you an example. You've got two investors, investor A and investor B. Investor A invests £12,000 at the beginning of January in a calendar year, when the price of the investment is £2 per unit or share. The other investor, investor A, instead of investing £12,000 up front, invests £1,000 a month, and the price starts off at £2 a unit or share, and gradually over the subsequent months it falls until it reaches a low of £1.52 in July, gradually increases and ends the year on £1.83. So remember, the price of units bought every month at £1,000 a month has averaged less than £2 a share, which was what investor B paid for up front in January. So the end result of this, in this particular example, was that investor A, who invested monthly and had the benefit of price falls, bought 7,077 units as opposed to 6,000 by buying up front, and paid an average price of £1.71 per unit, whereas investor B paid £2 per unit. And the final value at the end of 12 months for investor A, who invested monthly, was £12,923, whereas investor B, who invested up front, ended up with £10,956. Now, investor A, of course, invested monthly, whereas investor B paid up front. And because of the rises and falls over the year, investor A has the benefit of buying an average price lower than investor B. But of course, this is not always the case. You see, if prices had kept rising instead of falling, then investor B would have been better off and investor A would have been worse off. Investor A would have carried on paying higher prices because the average price paid would be higher than having invested at the outset. The upside of pound cost averaging is obvious when markets fall because you're buying at lower average prices. However, on average, share prices rise 6 months out of every 10 months, so 60% of the time, which means that on average you'll be worse off by using pound cost averaging. However, for risk-averse investors, especially those investing a large lump sum the first time in particular, for example, just before retirement, the peace of mind afforded by pound cost averaging may be considered worth it on balance. So if you're interested in investing a large lump sum and you are apprehensive about a potentially large fall in stock markets, why not consider pound cost averaging? You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.